Welcome, you're watching the Mutual Fund Show. I'm Tamanna Inamdar. Today we have a very special episode of the Mutual Fund Show. We're talking about what should you do with your portfolio ahead of Budget 2024. Now, the budget will be passed and will actually be presented by Finance Minister Nirmala Sitharaman on the 23rd of July. So we have less than a week or a little more than a week remaining for the budget to come through. Why this is also an important budget this time round is because it's the first budget of the third term of the Modi government, and we will get an insight into what is the policy landscape or the roadmap that the government is setting up. Now, why does this matter to your mutual fund investments? Well, let me give an example. Some of the best performing funds in the last few months, or even if I start from the last budget, the last full budget to now, have been thematic funds, PSU funds. There you have that list. We've taken the starting point as February 2023 when the last full budget was presented, and look at those funds. You have a PSU fund, you have an infra fund, and these are pretty much the ones which have really kicked off with their inputs. The reason for this is it's reflecting the government's focus on these sectors. Now, our question today and what we're going to be talking about with our guests is whether that is the kind of investment that you should make, and how do you see this as an opportunity to shore up your mutual fund investments. To talk more on this, I'm going to be speaking today with Kshitij Mahajan, Managing Partner and CEO at Complete Circle Wealth Solutions, and Tridip Bhattacharya, President and CIO of Equities at Edelweiss Mutual Fund. Let me first begin with Tridip and his view. Tridip, great to have you on the show and speak with us here on the Mutual Fund Show. Let's begin with your overview on what you're expecting from the budget. I know the industry also has its own set of wish lists when it comes to taxation, parity of taxation between debt and equity. Do you think these are some of the key themes that will dominate?
Yes, I think that is something which Honorable Prime Minister could address, Finance Minister could address. But I think the main focus is likely to be, which the market is waiting to hear really, from a broader direction standpoint, is this will be the first budget after the new government has sort of taken over with a slightly weaker mandate than what people thought of initially. So how much is the dilution to the focus that, or the promises that they had made earlier versus the continuity of the same going forward? How much do they have to relent in the form of populist measures are some of the key areas that at market participants we would be watching carefully to take a gauge on the future stance of the market overall. But if you were to ask me in terms of the focus areas for the budget, I would say that, broadly speaking, the path to Viksit Bharat 2047 would actually be seen in the, which actually continue in the form of incentives to sectors like capex, railways, autos, renewable energy, and manufacturing, and along with maybe a few measures to stimulate rural demand, because that's one area which has been sagging for a while and might be kind of taken into consideration by Honorable Finance Minister. So those would be the two specs that I would expect to get addressed, along with maybe taxation and stuff like that, would be my starting comments.
Okay, so taxation to boost consumption, your capital expenditure push continues, focus on rural demand. So, Tridip, if I were to ask you to translate that into an investment strategy, and especially for our viewers of the Mutual Fund Show, what would be your response?
I think overall, again, budget is just a small part of the investment horizon of investors, which should anyway be between 3 to 5 years. And if I were to look at the next 3 to 5 years, then I would say that 2 or 3 things will likely dominate investment returns. One is the overwhelming focus on manufacturing over consumption. I think with regards to capital creation, with regards to the government focus, and also private sector capex, given where the capacity utilization of India Inc. is, I think over the next 3 to 5 years, manufacturing over consumption would be one dominant theme that I would expect to play out from an investor standpoint. Second, I think given where valuations are within consumption, I think within consumption, rural consumption would actually have a few better days ahead, given the likelihood of better monsoon, and also that government would likely boost some measures which could kickstart demand in this area. So those would be overall from a sector overweight, underweight standpoint, manufacturing over consumption, and within consumption, rural demand over over urban demand over the next 1 to 2 years would be the areas to focus.
Okay, so focus on rural demand, focus on manufacturing over consumption. Kshitij Mahajan also joins us today. Kshitij, hi, great to have you on the show. As always, let's talk a bit about thematic funds, and let's now bring the conversation to the bread and butter, what people can do. All of these ideas sound great. We're looking forward to a constructive budget. The question is, how does it translate into some of your investment decisions? And we just pulled out that data. We'll put it up again for our viewers on what are the top performing funds from the last full budget. We've not taken the interim budget pre-election into question over here. We've started from February 2023 till now. Now 141%, for example, returns on the Invesco India PSU fund. So PSUs, defense, these are been some of the themes that have worked. Little surprised then there's so many NFOs coming out also around these themes. Are these a good idea, Kshitij, right now, or better to stay away? I think you're on mute, Kshitij.
Hi, Tamanna. Hi, Sudeep. I think Sudeep have set the context right in terms of expectation. So my worry here is, Tamanna, that wherever there is a valuation mismatch, irrespective of how focused government is, how focused our industry is, you will bound to see some correction, and that's what is happening right now. So these numbers are looking good. I can understand with the PSUs, defense, railways, but how many years you're discounting, one has to take into account. And when you're talking about the funds which are sectoral specific or thematic funds, which we spoke earlier also, I think one has to focus on clear cut what. With this little bit of fracture mandate, I would say the government has come, not with a clean mandate, I must say. What type of focus they will have? One, ruler for sure. So I think the way, we all have that 15, 20 years of work in this industry, and we have seen the sectoral rotation is becoming very fast. So one has to understand the theme, the focus of government will be ruler for sure, and you have the ruler demand consumption piece will do well. At the same time, manufacturing will remain the flavor because they are very clear they want to have 25% contribution of GDP coming from manufacturing by 2030. That will create jobs as well as you become self-reliant, less dependency on imports. So that will keep on growing. But yes, wherever, in that piece also, the valuation mismatch is there. One has to be a little careful. And I don't mind, booking some profit or maybe taking some chips off from all these high-valued sectors or themes or stocks where earnings are not that supportive. But yes, I see that in current scenario, wherever you are seeing some new funds coming, so just be watchful with the valuation, the type of holdings which, because they propagate about what type of sector, what type of industry they are investing into. Just be a little watchful about the valuations also, because end of the day, at any given point in time, if it's not catching up now, earning has to catch up or price has to go down. So it has to marry both sides. So I think this is something which is worrying me. But consumption is one sector where I see one can actually look at participating. This is something which is very this is a personal view. There's no recommendation. Second thing which I see that BFSI as a sector or maybe as a theme which has not played well in last 4 years is dragging, or maybe it's underplaying Nifty as number also, that two sector. Manufacturing as a broader theme, yes, it will and it should do well, but then you have to pick your pockets. So I think at present scenario, just look at those sectors where the valuation mismatch is not much. And otherwise, you can play these themes through flexi-cap or multi-cap funds. That's a better way of doing it, rather than just looking at playing it through pure sectoral or thematic funds. Because to my extent, whatever I understand from market scenario right now, there is some sort of froth building up in some space, whether it's PSU banks, PSU companies, defense, some few of the stocks. and then you have railway stocks. So one has to be a little watchful and careful while investing into these type of themes.
Okay, so now I'll tell you the one line from your commentary or opening comments that really struck me, and I want to come back to, Kshitij, is where you said, I don't mind booking some profits at this point in some of these funds which have run up. Let's get into that more specifically. I mean, a lot of people right now are wondering whether there is one bout of profit booking coming. A lot of investors have seen handsome returns, to say the least. Would you say it makes sense to go back, look at your portfolio and maybe unwind some of those positions or book some of those profits?
Yes, Tamanna, very well. You said it rightly. Asset allocation is one thing which we always come out with. And with the current equity run-up, you see that you must have, whether you have not gone back and seen, but if you see that your asset allocation is way towards in excess of what you have thought of participation in equities. So if you want to rebalance it, and right now you have a very lucrative window in fixed income also. So I'm just taking a deviation from what we are discussing. You have fixed income part also where you have gilt funds where we are expecting a rate cut which are very much capable of delivering 10-11% in next 1 year's or next 1 year's time. So I think it's a good time where you can actually look at booking some profit from those funds which have rallied up really fast and not with the proper earning guidance for next 5, 6, 7 years, or maybe not supportive earning guidance. So wherever there is a mismatch, I again use the term, and the mismatch is really big. I don't mind, booking some or taking some chips off and booking some profit and parking the same back to fixed income as and when you have some opportunity coming your way. Keep some powder dry, and you can participate again into those sectors or maybe a multi-cap fund. Or if you don't want to do it at your service rebalancing, maybe you can move to a balanced advantage fund. In fact, even Edelweiss has a very beautiful balanced advantage fund. So you can look at participating into any of the BAPs. So I think that's a right way to do rather than just fixated with that. Okay, I have this. This is the run up, and this will keep on going. I don't think so. Wherever there is a mismatch, it will keep on going like this.
Okay. All right. So look at that. You're seeing on an average, large cap funds have given you between 59 to 60% returns since the last budget. Some of your thematic funds are 130, 140% returns. I mean, it's been a dream run. Trideep, I know it's a tricky question for you, but nevertheless, without talking about any specific fund, I am going to ask you that question. Is this a time, if you're looking at your portfolio at an individual level as an asset manager, to review and take some profits off the table?
I think profit booking and as long as you can put it to work in reinvest it at a level where returns are better should always be looked at. And I would say if you look at over the last 1 year or so, particularly the data that you are showing us shows a meaningful amount of returns have been made in some of the areas like PSUs and also some of the other areas like infrastructure and stuff like that. So two aspects to this. One is that, I think at the moment, one statement I would clearly make without making life tough, which is that I think generally diversified funds make a lot of sense at this point in time than sectoral funds. That's the first statement that I would make, because in diversified funds, the fund manager has the flexibility to move between themes, basis, the changing direction, and also the changing valuations, which are moving quite significantly. Now, in this context, for instance, in the last month or so, there was a large defense index fund which has been launched overall. So clearly, some of those stocks have had very strong days overall from that perspective. Now, that's not to say that the government's focus from defense is likely going to go away. No, in fact, it's going to probably strengthen. But versus that of valuations, given that we have seen already stocks run up quite meaningfully, maybe things may even out over a period of time. Hence, I was suggesting that two of the categories of funds which are my favorites in this current circumstances would be a flexi-cap fund or a multi-cap fund, because it kind of gives the investors and the fund manager leeway to move around wherever valuations are still sanguine, earnings growth still robust, and valuations don't fully capture what earnings growth is likely to reflect. So maybe from some of these thematic funds profit booking could be seen, looked at, and moved on to more diversified funds like flexi cap and multi cap funds. That certainly I would probably wouldn't mind shying away from talking straight on your show.
Yeah, I'm glad for that, Pradeep, and really appreciate it because that's what at the end of the day we're talking about investors and viewers. Our favorite part of the show where we take your queries and get our experts to answer them. Kshitij Mahajan with us today to do this. Our first question, which we're taking up today, is from Pritam, aged 44. And Pritam asks, is it true that most active funds do not beat index funds in the long run? If I'm looking at a 20-year investment horizon, is it better to remain invested in index fund? Excellent question from Pritam. Kshitij, how would you look at this? Also from the point of view that your costs are lower in index fund, isn't it? So you have to account for that at some point.
I agree, Tamanna. It's a very good question. And in current scenario, when we're looking at that most of the funds across category, they are doing so well. So where index funds stand. So I agree that in large cap category, yes, it's always better to play through index rather than just playing through fund because one, as Tamanna said, the expense is less. Second, after 2018, the new regulation has they have come in which you can't invest, you have to invest more than 80% portfolio into top 100 stocks only. There is less flexibility, which is there with large cap fund. So rather than doing a large cap or blue chip fund, one should look at Nifty 50 or next Nifty 50. Otherwise, you should play through active funds as India is not that discovered as a market. And we are evolving, we are coming up the curve. So we have a lot of opportunities coming our way on the flexi cap, multi cap side of the businesses. So I think that's a better way to play. And that's not true that index has beaten, most of the time index has beaten most of the funds. That's not right. But yes, on the large cap side, yes. Last year, obviously, the active fund on the large cap space, as shown by you only, they have beaten the index hands down. But otherwise, if you want your money to be grow for next 20 years, you want to invest through SIP or a lump sum channel, whatever channel you want to use, I think the best way to do is include one large cap or at the max 2 large cap or let's say multi-cap index funds. Otherwise, just play it through open-ended mutual funds because there you can find that there's always 2 to 3% delta they can create with the index fund in the next 15-20 years. So one can have a yeah.
So just so you're talking about the data we're showing. Just to re-clarify, that data is from the last budget. And these stocks, those bucket of stocks have been the ones in focus, right? Your defense, PSU, etc. Our guest, our viewer actually, Pritam, is talking about a 20-year horizon. Now, over a 20-year horizon, does the story change?
So let's talk about the past. Future nobody knows. If you see last 20 years, Nifty on an average has given return of 14.5-15% compounding. That's the type of return which Nifty has generated on a compounding basis I'm talking about, wherein most of the active funds have delivered much more than that. Now, this is aberration because we all know last 4 years have been really very good. That's why everything looks good. But yes, large cap funds after 2018, they have to change their nomenclature in terms of their holdings. There you have seen underperformance. And there I totally agree that rather than doing a large cap pure vanilla blue chip fund, one can look at an index fund. So otherwise, multi-cap and flexi-cap funds have done really well vis-a-vis index funds. Or let's say vis-a-vis the index, they have outperformed index with 1.5-2% margin. And if you look at the future part, so nobody knows the future, but I can tell you something that we will keep on getting a lot of opportunity in open-ended funds. So given an option, if I talk about my portfolio, I have only one index fund, wherein on the large cap side. Otherwise, I do flexi cap funds, multi cap fund, large and mid cap fund. That's what I invest into. And I see that going further also. Index investing, yes. When you talk about the cost part, it is cost efficient. But in terms of it is fixated, it's a mirror image of what index will do. So, Tamanna, let's say we have a 12% nominal GDP growth. Let's assume 6.5-7% GDP, 4.5-5% inflation. Then we can expect in line with that index returns also, because that's a reflection of our economy only. So that's what we can look at 12 to 13% expectation from Nifty index going further. But active funds can give you 14-15% return. That's what I believe.
Okay. Okay, so active funds can give you 14 to 15% return, and that's something you have to look at as well. So a combination might work best. All right, Mehul Gupta is our next question. It's 25. Asks, is the new travel and tourism index a good space to invest in? Says, I am looking to invest in the Tata Nifty India Tourism Index NFO. Now, this is also a great question, Kshitij, because it gets gives us an opportunity to explore so many themes, including thematic funds, NFOs. But let's start with a specific question from Mehul. What do you make of the new travel and tourism index?
Oh, I travel because of my work, and I see everywhere there are, irrespective of vacation, they are not there. There are travelers around. I think one mindset change what has happened, and as we speak, we are around $2,731 per capita GDP. I think we have a lot to catch up. And once your GDP per capita GDP will cross 5,000, 5,500 in the next 4 5 years time, your discretionary spend will go up. In which the travel, tourism, buying a better car, anything which has to do with lifestyle, upgrading your own lifestyle will you will see a remarkable jump. Second, in India especially, we have seen that religious tourism is catching up really fast, and there are more travelers in Ujjain than Goa. Now you will see the same thing happening in Ayodhya and a few other places also. So that is also catching up really fast. So I think tourism as a sector, as an industry, will and should do very well, and not only in India but abroad also, as far as the Indians are concerned. So you go out, you see a lot of Indians now, you have Indian food available everywhere. So I think the industry will do well. Now, when you look at an NFO part, one has to actually look at that. You should get into a sectoral fund or any type of small cap fund with a view that when you have the risk appetite which is on your side, that yes, if the sector will not play well, then you might end up not making the type of money which you're expecting. So that's my personal view, but it can be someone's view that sector will do very well. But then that risk appetite, if you have with you, then you can look at participating in this type of fund from 5 to 8% is one can look
so,
at.
1 minute, just one quick follow-up there. And you're absolutely right. The industry is booming. You're seeing that in some of the listed players as well. Does the index or this particular NFO, that he's talking about the Tata Nifty India Tourism Index NFO, give you that kind of coverage and exposure to the travel boom? Because remember, the idea is to capture that as an investment avenue.
Yeah, it does, Tamanna. In fact, I talked to Tata, team here in Bombay and Delhi, and they was talking to me about everything to do with travel. That includes your bags, that includes your various other stuffs, food side, your airline, your let's say hotel industry. They are covering everything. So as you said in the beginning, it's a broader sector. So, and it helps a lot of people when travel starts. It helps a chaiwala also who starts a teak stall near to some tourist place. So it's a very broad sector, and it will actually help a lot of people when the industry booms. So it will cover on a holistic way a lot of these companies underlying the fund.
All right. I have barely any time. Let me see if I can take one quick question from Surabhi Mantha, age 30, says, ask, is it a good idea to remain invested or invest further in Quant MF after the recent changes in management and SEBI investigation? Very little time, but do you want to quickly address that, Kshitij?
I don't think one should add on to quant investments. I must say, if you have SIPs going, one should stop, allow this entire dust to settle. Maybe again, if you want to start, then you can start. One last thing, Tamanna, if you are in a small and mid-cap category, I don't mind taking some chips off because the run-up is really sharp. There is froth out there. And if some discovery will happen, I hope nothing will happen, then it might impact the overall fund and redemption can cause NAVs to go down because this is something which is worrying. Otherwise, I don't think need to add or redeem other funds. So this is my submission here.
All right. So no need to add more. You might look at reducing some of your holdings if you are already in. That's the word coming in from Kshitij Mahajan. All right. Thank you so much, Kshitij. For our viewers, you know where to reach us, numbers on your screen. But that's all the time I have on the Mutual Fund Show today. Thank you so much for watching. We'll see you back tomorrow, same time, same place.